Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Today, I'm going to talk about how we're trying to simplify the complicated questions of recent geopolitical events. It's Friday, June 27th at 2 p.m. in London. Recent U.S. airstrikes against Iran and the ongoing conflict between Iran and Israel have dominated the headlines. The situation is complicated, uncertain, and ever-changing. From the time that this episode is recorded to when you listen to it, conditions may very well have changed again. Geopolitical events such as this one often have a serious human, social, and financial cost, but they do not consistently have an impact on markets. As analysis by my colleague Michael Wilson and his team have shown over a number of key geopolitical events over the last 30 years, the impact on the S&P 500 has often been either fleeting or somewhat non-existent. Other factors, in short, dominate markets. So how to deal with this conundrum? How to take current events seriously while respecting that historical precedent that they often can have more limited market impact? How to make a forecast when, quite simply, few investors feel like they have an edge in predicting where these events will go next. In our view, the best way to simplify the market's response is to watch oil prices. Oil remains an important input to the world economy, where changes in price are felt quickly by businesses and consumers. So when we look back at past geopolitical events that did move markets in a more sustained way, a large increase in oil prices, by which we mean a rise of 75% or more year over year, was often part of the story. Such a rise in such an important economic input in such a short period of time increases the risk of recession, something that credit markets and many other markets need to care about. So how can we apply this today? Well, for all the seriousness and severity of the current conflict, oil prices are actually down about 20% relative to a year ago. This simply puts current conditions in a very different category than those other periods, be they the 1970s or more recently Russia's invasion of Ukraine, that represented genuine oil price shocks. Why is oil down? Well, as my colleague Martin Ratz referred to on an earlier episode of this program, oil markets do have very healthy levels of supply, which is helping to cushion these shocks. With oil prices actually lower than a year ago, we think that credit will focus on other things. To the positive, we see an alignment of a few short-term positive factors, specifically a pretty good balance of supply and demand in the credit market, low realized volatility, and a historically good window in the very near term for performance. Indeed, over the last 15 years, July has represented the best month of the year for returns in both investment-grade and high-yield credit in both the U.S. and in Europe. And what could disrupt this? Well, a significant spike in oil prices could be one culprit. But we think a more likely catalyst is a shift of those favorable conditions, which could happen from August and beyond. From here, Morgan Stanley economists' forecasts see a worsening mix of growth and inflation in the U.S., while seasonal return patterns flip from good to bad. In the meantime, however, we will keep watching oil. Thank you, as always, for your time. If you find Thoughts of the Market useful, let us know by leaving a review wherever you listen, and also tell a friend or colleague about us today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.